Welcome to the TEK2day podcast, powered by CEO Rater. It's your host, John Mayetta. I don't know why every piece of research coming out of the street treats this inflation issue as mutually exclusive, meaning it's either transitory or it's not. I don't know why everything has to be binary on Wall Street. It can be both. There are transitory elements, there are elements that are more permanent. So I'm not sure why the research is so unsophisticated coming out of the sell-side shops and buy-side commentary for that matter. Second, we're kidding ourselves by playing into the Fed's narrative of focusing the inflation discussion, or rather defining the inflation discussion entirely based on the CPI metric, which is myopic. You've got to contemplate the various asset bubbles, equities, cryptocurrencies, materials, right? I mean, there are all sorts of bubbles that I've talked about and written about a number of times, as have other people. So it's more than just increases in CPI. So to remind investors of that fact, to try to educate institutional investors, who some of them need to be educated, and some, I believe, just have blinders on. They don't want the facts, because the narrow set of facts as presented by the Fed fits into the narrative that many PMs and CIOs have staked their thesis on. So I want to burst that bubble. I want to burst that delusional bubble. So today we put out a piece at TEK2day that talks about the NASDAQ Composite and growth in the money supply. And I would encourage you to read the article. Sometimes on the podcast I may misspeak, and I may not catch my mistake in editing. But as it's written, our content is correct. Right, so I looked at the percentage change in M2 from April 2020 through March 2021. And I looked at the percentage change by month in the NASDAQ Composite. And the idea was, or the hypothesis was, that the growth in the money supply drove higher valuations in the equity market, specifically here in the NASDAQ Composite. There's some of that, if you just think about it logically, some of that benefit to the NASDAQ Composite in terms of M2 growth would be directly, right? Because we sent out money to businesses as part of the PPP plan. We sent out money to individuals as part of the federal pandemic unemployment relief program. And so you would think some of that capital found its way directly into NASDAQ-listed companies, NASDAQ-listed names. Secondly, some of the federal programs, especially those run by the Federal Reserve, which required the printing of money. So I'm thinking about the corporate lending facilities and such, the government agency asset purchase programs, right? These also would have benefited in part NASDAQ-listed names. For example, I remember Apple. I think the Fed purchased $3 billion worth of Apple-issued debt last year. And just the Fed, being in the market, even though it was, in some cases, it was at arm's length through BlackRock. But just the Fed's presence put a floor on markets and or lifted markets to a degree. So what you'll find is, in looking at that period, and by the way, we wanted to look at April 2020 because that's when the printing started, and then we stopped. We used March 2021 as an endpoint because that's when NASDAQ started to pull back and flatten. So I just wanted to, measure as to whether that lift in NASDAQ valuations, that run up, if there was a relationship, a correlation in that run up with the growth in M2 over the same period. And by the way, we lagged the NASDAQ monthly observations by 1 month versus the M2 observations. The thought being that if money is printed at T0, then perhaps it would take a month to find its way into the markets. And what we found when we ran our correlation coefficient on those two data sets, percentage change in M2, percentage change in the NASDAQ Composite, 81.7% correlation coefficient, which means a very high correlation. I mean, I think it's just common sense, but this wraps some numbers around what you would think would be common sense. And it's just, again, it's our attempt here at TEK2day to remind institutional investors and retail investors, anybody who's interested, that inflation is more, price inflation is more than the narrowly defined CPI measure that the Federal Reserve uses. And the Federal Reserve, in using that narrow measure, they are able to define the narrative and tell the markets that, hey, it's okay. Inflation is, a bit higher than our 2% average, but that was always the plan. Right? I don't buy the data in that CPI basket, nor do I buy CPI as an encompassing measure of price inflation. And then if you want a second article, so that one that we just discussed is the most recent TEK2day article. And that was published late morning on Thursday, late morning East Coast time. We published another article early morning East Coast time on Thursday, which talked about focusing on cash flow rich names as a defensive measure in an inflationary environment. The thought being that when this bubble bursts, it's going to burst in a violent fashion, given that so many market participants are just looking through inflation. And I've heard so many people tell me that, it's priced in. Inflation's priced in, the potential increase in interest rates is priced in. I just don't buy it. I know that's not the case. I've seen that movie before. And in this article, we link to the economic release that came out yesterday, the U.S. import and export price indices, which detail 11.3% import price increases and 17.4% export price increases over the trailing 12-month period. And you can click on that detail and read the release and the charts and such for yourself. But and that, by the way, the point being that release is a truer measure. It's not so myopic as the CPI measure. So 2 articles, food for thought. That's all for now. See you next time.